Julia Lee, equities analyst at Bell Direct, joins us. Julia, hi. Thanks for joining us.
Hi, Mark. How are you doing?
Good, good. Are you breathing a little easier, Julia, after Friday's US jobs report?
I think markets here in Asia are breathing a little bit of a sigh of relief. The numbers were better than expected, but if you break down the numbers, they weren't fantastic. If we have a look at that private jobs area, we saw about 10,000 jobs being added because of those construction workers coming back after being on strike, and a lot of that was part-time jobs as well. So the numbers better than expected. So we did see the US market up by 1.2%, but not fantastic.
I mean, a consensus, Julia, seems to be growing that we're not going to fall into double dip, but growth's going to be tepid from here. I mean, a tepid environment for growth. What sort of environment is that for equities?
Unfortunately, it's not a fantastic environment for equities. If we have a look at some of the pros in terms of the better than expected data coming out, the job numbers, of course, at the top of the list last week in the US, but we also saw Chicago PMI numbers better than expected, China's PMI numbers better than expected. But on the downside, the manufacturing sector, which has been responsible for a lot of the recovery in the US, not looking too good. In fact, if we have a look at the jobs numbers, 27,000 jobs having been lost out of the manufacturing sector in the month of August. Also, if we have a look at factory orders in July, up less than expected, up by just 0.1%. And inventories are climbing, pointing to the fact that perhaps US production is going to decrease. So things still looking a little bit shaky, although the threat of that double dip has reduced somehow.
I mean, Australia seems to be one of the economies that's outshining on a growth level, on an employment level. Just look at the export numbers. I mean, it's all positive relative to many of the other G7 economies. Is it a real gauge of risk right now, Australia, Julia?
If we have a look at the Australian share market, if we have a look at the Australian currency, a lot of it is seen as a gauge of risk. If we have a look at overseas investors in Australia, they account for about 40% of the share market holdings here in Australia. So if we have a look at the flows in and out, Australia is very much seen as a barometer for risk. Now, the Australian market is doing well today, and it has been doing quite well over the last few weeks, and that's really because the Australian economy has been doing very well. We've seen second quarter GDP numbers looking very strong. We've seen strong jobs growth, and it does look by the end of the year we're going to see the unemployment rate in Australia perhaps below that 5% rate. So the Australian economy is looking very good, but unfortunately for the Australian share market, it very much trades on a very high correlation with the US market.
So what's the strategy, Julia? I mean, how do we make money in these difficult times?
If we have a look at the Australian share market over the last 5 to 6 months, we have seen it in a very strong trading range. And if we have a look at the technicals at the moment, the Australian market is at a pivotal point. If we can break past the 4,600 point mark, things are looking pretty good for the Australian share market. But this week, if we see the Australian market start to pull back again at the upper end of that range, then it does look like we are going to be stuck still in that trading range. And of course, the bottom end of that range is at 4,200 points for the S&P ASX 200 index.
Thanks, Julia. Julia Lee there from Bell Direct in Sydney.